If you're earning an income in Canada, you have access to one of the most powerful tax reduction tools available, the Registered Retirement Savings Plan. Yet most people get it wrong. Here's what we'll cover: understanding 2026 RRSP contribution limits, the mechanics, how RRSP deductions actually work, and Strategy 1, strategic deduction timing. Stick around, the strategies in here add up to real money. The RRSP contribution room you can use in 2026 is determined by two factors: the annual dollar limit and your prior year earned income. Unlike TFSAs, an used RRSP room carries forward indefinitely with no expiration date. If you didn't contribute in 2023, 2024, or 2025, that room is still available to you in 2026. You can catch up at any time in your life, even in retirement, as long as you have earned income during the accumulation phase. The mechanics, how RRSP deductions actually work. In this scenario, a $10,000 contribution nets you a tax refund of approximately $2,965, a combined marginal rate of 29.65%. When you reinvest that refund, you've increased your invested capital to $12,965 using the same out-of-pocket amount. At $50,000 income, a $10,000 contribution saves $1,905 in taxes. At $200,000 income, that same contribution saves $4,341. This is why high earners benefit more from RRSPs, and why strategy matters more at higher income levels. Here's how it actually plays out. You contribute to your RRSP. You transfer money from your bank account or investment account into your RRSP. There are no immediate tax consequences. You claim a deduction on your tax return. On your annual tax return, or later, if you defer, you claim the contribution as an RRSP deduction, reducing your taxable income. Your tax bill decreases. By reducing taxable income, you owe less tax. The tax savings equals your contribution amount multiplied by your marginal tax rate. You invest the refund. CRA, or your employer, if you adjust your payroll, returns the tax savings as a refund, which you can reinvest or use for other goals. Most people assume you must claim an RRSP deduction the year you contribute. By deferring the deduction from 2026 to 2027, you gain an additional $960 in tax savings on the same $10,000 contribution. The money grows inside your RRSP during 2026, and you get the larger deduction when you need it more. When you defer a deduction, you're using your contribution room in 1 year but claiming the deduction in another. This doesn't affect your contribution room, but you must keep careful records. CRA won't remind you that you have an unclaimed deduction sitting on your return. You have to claim it within the following 6 years. Here's the priority order from here. Expected promotion or raise, you know you'll earn more next year. Contribute now, claim later. Bonus year, you received a one-time bonus in 2025. If you don't expect it again in 2026, consider deferring the deduction. Pending variable income, freelancers and commission earners can contribute in low-income years and claim in high-income years. Part-time to full-time transition, moving from part-time to full-time work? Contribute while part-time, claim when full-time. If you're married or in a common-law partnership, a spousal RRSP is one of the most powerful tax and retirement planning tools available. The contributing spouse, higher earner, claims the deduction, not the account holder. The money is deposited into a spousal RRSP registered in the lower-earning spouse's name. When withdrawn in retirement, the lower-earning spouse pays tax on the withdrawal at their lower marginal rate. However, there's a 3-year attribution rule. If the lower-earning spouse withdraws funds within 3 calendar years of contribution, the withdrawn amount is attributed back to the contributing spouse for tax purposes, and they must pay the tax. If your spouse withdraws within 3 calendar years of contribution, the attributed amount is added back to your taxable income. This rule exists to prevent abuse, but it's easy to manage. Just wait 3+ years before your spouse withdraws. Contributing to a spousal RRSP uses your contribution room, not your spouse's. You still claim the deduction. If you have $15,000 of contribution room and contribute $10,000 to a spousal RRSP, you have $5,000 of room left, and your spouse's room is untouched. Strategy 3, the RRSP Refund Recycling Hack. That $460,000 difference is the pure power of reinvesting the tax refund. It's not complex, but it requires discipline. You must actually invest the refund rather than spend it. The refund can go into, some aggressive strategies suggest borrowing to maximize RRSP contributions and then recycling refunds. This works mathematically if investment returns exceed the loan interest rate, but it adds complexity and risk. For most people, contributing what you can without borrowing, and recycling the refund, is the right approach. Here's the priority order from here. Contribute to your RRSP, using borrowed money, savings, or a bonus. Receive the tax refund from your RRSP deduction. Invest that refund in a TFSA or non-registered account. Compound grows in the TFSA tax-free, or with deferred taxation in non-registered. Repeat annually if possible. The Home Buyers Plan is a government program that lets you withdraw up to $60,000 from your RRSP tax-free to purchase your first home. The HBP is especially valuable if you can contribute to your RRSP, immediately withdraw it for your home purchase, and claim the deduction. Here's a smart approach. Why? Because the HBP withdrawal doesn't come with a refund. You contribute $18,000, claim a deduction, get $5,400 back, 30% marginal rate, and then you still have to repay the $18,000 over 15 years. Instead, use the refund towards your purchase and leave the RRSP to grow. HBP is most valuable if. Here's the priority order from here. Maximum withdrawal, $60,000, increased from $35,000 in 2024 for a limited time. Repayment term, 15 years, you'll pay it back gradually. Eligibility, first-time home buyer, haven't owned a principal residence in the prior 4 years. Timeline, you must use the withdrawn funds within 15 calendar months of the calendar year you make the withdrawal. Contributing beyond your allowable room triggers a 1% per month penalty on the excess. Even though CRA allows a $2,000 lifetime buffer, people often exceed it accidentally, especially if they receive multiple T4S or have employment income plus self-employment income. Fix, check your CRA notice of assessment or my account before contributing. Call CRA at 1-800-959-5525 if unsure. The penalty is expensive and avoidable. You withdraw $10,000 from your RRSP to pay for a vacation or to cover an emergency. Sounds simple, but CRA withholds tax immediately, 20 to 30% depending on province and amount. You never see that money. Worse, the full $10,000 is added to your taxable income, so you may owe additional tax at year-end. Fix, treat your RRSP as truly locked in. Use a TFSA or non-registered account for money you might need before retirement. You contribute $10,000 to your RRSP and leave it in a savings account earning 0.5% interest. Meanwhile, the stock market returns 8% annually. You've sacrificed the tax refund benefit, which cost you $3,000 upfront, without capturing any investment growth. This is a pure loss. Fix, invest your RRSP contribution immediately in a diversified portfolio aligned with your risk tolerance and time horizon. Cash is a drag on returns, especially over decades. If you're in a 15% tax bracket and contribute $10,000, you save only $1,500 in taxes. Later, when you're earning $150,000 and in a 38% bracket, that same contribution would save $3,800. Timing matters. This is especially relevant for students, people between jobs, or early career professionals. Fix, if you're in a low bracket, consider using a TFSA instead, or contribute to an RRSP but defer your deduction to a higher income year. Claim the deduction when your marginal rate is highest. If one spouse earns $150,000 and the other earns $40,000, and the higher earner contributes to their own RRSP, they're missing out on income splitting in retirement. The spousal RRSP mechanism exists to address exactly this problem. Fix: if income is unequal in your household, direct a portion of the higher earner's RRSP contribution room to a spousal RRSP. The higher earner still gets the deduction, but the lower earner builds retirement savings. Use this to estimate your potential refund and plan your contribution strategy. Asterisk: combined federal and provincial marginal rates vary by province. Rates shown are approximate, Ontario-based, your province may differ. Find your approximate annual income in the table above, then multiply your planned contribution by your combined rate. That's your expected tax refund. If you're in the $100,000 income range and planning a $15,000 contribution, you can expect roughly $4,447 back. Plan to reinvest that refund in your TFSA or non-registered account. An RRSP isn't a one-decision investment vehicle. Check your CRA Notice of Assessment or My Account to confirm your available contribution room. Add any carry forward from previous years. Write down the number. What's your current marginal tax rate? Is it likely to increase in the coming years? Promotion, new job, side income? If your rate will rise, consider deferring your deduction. Will you contribute to a personal RRSP, a spousal RRSP, or both? If married, does your household have income inequality that warrants a spousal strategy? Contribute your target amount and invest it immediately in a diversified portfolio. Don't leave it in cash. When you file your taxes, claim your deduction and get the refund. Invest that refund in a TFSA if you have room, or in a non-registered account. This refund recycling amplifies the power of your contribution. You've got the playbook. Keep optimizing.